Freddie. Thank you for coming to my live stream. I'm Daryl Fairweather. I'm Redfin's chief economist. I'm also the author of the book Hate the Game. And I use these live streams to talk about what's happening in current events and what's happening in the housing market. And as always, I like to start off this conversation with an overview of our latest Redfin News housing market data. So the big news this week is that US pending home sales have risen to their highest level in 6 weeks. And the reason why this is because of mortgage rates. Mortgage rates were down the last couple of weeks because we had seemingly come to a agreement with Iran to end the conflict and reopen the Strait of Hormuz. That all changed this week. It seems like the ceasefire has ceased to exist. So my impression is that this increase in pending sales is probably going to be short-lived because the decline in mortgage rates itself was short-lived. So for now, at least, pending home sales are up 1.3% from a week earlier, which is their highest level since the first half of May. Usually pending home sales increase around this time of year. Sellers tend to list their homes in spring, and then buyers tend to get the most active in summer. So it's not unusual for pending home sales to be increasing this time of year. But it's really just a mortgage rate story. Home buying demand picked up, well, partly because of temporary declining mortgage rates. The weekly average rate dipped down to 6.43% on July 2nd, which was its lowest level in 6 weeks. Because of the negotiations with Iran seem to be going well, but then now they seem to be going badly, and the daily average mortgage rate was 6.7%, according to Mortgage News Daily, as of yesterday. I think it wasn't much far off today. So it just goes to show how sensitive home demand is to mortgage rates. Let's see what's happening with new listings. It's always normal for buyers to back off whenever mortgage rates go up and for buyers to come back when mortgage rates come down because it directly impacts their ability to afford a home, because the higher mortgage rates are, the higher their payments are. And there's usually a cap for these buyers in terms of how much they can pay per month, either set by their lender or set by their own budget. But sellers nowadays are also pretty sensitive to mortgage rates because they have the mortgage rate locked in effect. Yeah, it looks like for the last couple of weeks, new listings were up 2%, although they were down 2.5% from the previous week. But that's normal for this time of year. Sellers usually list in the spring, so it's normal for there not to be as many new listings in July. Although I'm pretty sure this is this is seasonally adjusted. So I guess they did go down in real terms in this last week, which is, I guess, a little bit surprising. I would have thought sellers would come back the same way buyers did when mortgage rates fell, because a lot of these sellers want to sell and become buyers again, but they didn't. They stayed on the sidelines, at least on a weekly basis. So maybe that tells us a little bit about what could happen to the housing market if mortgage rates were to fall. I've been thinking that if mortgage rates fall, it would bring back sellers as well as buyers, so we wouldn't see much of an increase in prices. But just based on this little temporary experiment where mortgage rates fell for a couple of weeks because of what was seeming to be progressing in Iran, in this little experiment, it looks like sellers did not come back, or at least they didn't come back very quickly. Sellers can be a little bit slow. It takes a lot of time to plan a listing of a home. It's easier for buyers to come off the sidelines. It doesn't take that long to talk to a lender and get a rate locked in and start making moves, especially if you've been waiting for rates to drop. So maybe I shouldn't be reading too much into this, that sellers did not come back in that short time frame when mortgage rates dropped. But anyway, this is all kind of a moot point because mortgage rates are back up, so we're kind of back to where we started. Cool. So welcome everybody to my live stream. If you are watching, feel free to leave a comment. I'll be reading the comments. Okay. So yeah, let's talk about Iran. So tensions with Iran add fresh uncertainty to an already shaky global economy. No kidding, says me about Scott Horsley's reporting over at NPR. There's been renewed fighting Crude oil prices jumped, stocks fell, mortgage rates increased. None of that is really all that surprising, because the reverse happened when it seemed like we were headed towards a deal, or at least we had a deal with Iran. And now, negative progress on that front. Negative progress, not only for the political situation, the geopolitical situation, but also negative progress in terms of the economy. And this isn't just affecting the US economy. The global economy seems to be I know it's impacted. It's being impacted as well, but the news is that the IMF, the International Monetary Fund, the institution that lends money to countries all around the world, they care a lot about what's happening in the global economy because they're making these loans to countries all around the world. They have projected that world output growth would fall to 3%. And they're blaming that on high commodity prices. And if you read the article, the high commodity prices are because oil prices are up and oil is an input into commodities. They specifically call out the damaging toll from the United States and Israel to attack Iran this year. Those attacks we know what happened. But the point is that output growth is going to fall to 3% according to the IMF because of what's happening. All right, we got a question from Greg over on X. This is my first question. This is my first comment from somebody on X. It's so funny because X and my stats always shows that like hundreds of people are watching, but they never comment. So thank you, Greg, for commenting and showing me that X isn't completely making up the viewers when it comes to my live streams. Okay, Greg says, do you have any thoughts on Fannie and Freddie? They bought mortgage-backed securities to drop the rates. Then Iran, the government has talked about releasing them. Any thoughts on if or when that would happen and the impact? So back, I believe it was in February, the Federal Housing Authority, Fannie and Freddie, thanks, Greg, they bought $200 billion worth of mortgage-backed securities. I remember this happening because the day that it was announced, mortgage rates dropped by about 10, 15 basis points. It did have seemingly a noticeable impact on mortgage rates. But then there was the war in Iran, which spiked mortgage rates by 25 basis points the day that we attacked Iran. I think that's how much it went up by. I remember this number very clearly in my head, that Mortgage News Daily was reporting that mortgage rates for 30-year fixed were 5.99% the day before we attacked Iran, because it was very big news that mortgage rates dropped below 6%, and then the day after, I think they went up to 6.3%, maybe even higher. I want to say 6.3. They're higher now. They're up to 6.7%. Okay, but the question is, what's going to happen next? The government has talked about releasing them. I wasn't aware that the government is releasing these mortgage-backed securities. Does that mean selling them? Because that would increase interest rates even more. Buying the mortgage-backed securities dropped interest rates. If they were to release them, sell them, that would mean that they'd have to sell them for essentially a lower price. And in the world of bonds, lower price means higher rate, because you have to give the investors a better deal, a better return on the mortgage-backed securities if you're expecting them to buy this huge volume of them when they otherwise were not interested in buying them. So that would increase rates. So I don't know, releasing them from conservatorship. Let me see what's going on there. Freddie, Fannie, MBS. See, you're asking me for my opinion, but obviously I haven't really researched this too much. Oh no. Oh, releasing this. Oh, I see what you mean. Releasing the agencies themselves from conservatorship, not the mortgage-backed securities themselves. Yeah. Okay. There is a movement to get Freddie and Fannie out of conservatorship. They were put in conservatorship during the Great Financial Crisis as out of necessity, because too big to fail. We couldn't let these government-sponsored entities fail. They went under government control fully, and it's been a long time since the financial crisis. Maybe it's time to release them from conservatorship, because why is the government so involved in the U.S. housing market? They're going to be involved no matter what, but maybe privatize it more. Maybe they'll be more efficient if they're privatized. I haven't seen much movement on it. I don't think that it is a politically, I don't think that there is enough consensus on what should happen to Freddie and Fannie. And it's also one of these situations where it's like, if it ain't broke, don't fix it. Like, if it seems if it broke before, right, when it was not under conservatorship, that's why it was put under conservatorship. Things are going pretty okay now. So why change things? I don't think there's a lot of political will to change things when there's nothing broken at the moment. So we'll see what happens. I mean, I don't think it's going to happen, I guess, is just my take on it. I'm not necessarily against it, but I don't think there's enough political will or even like a strong enough argument for why they should be released from conservatorship. I don't think the American public would understand what the reason would be to like get their politicians to support it. I don't think the politicians themselves like have a good framework on it unless they happen to really be, tapped into the investors who might purchase shares in these government sponsored entities if they were released from conservatorship. So yeah, I don't think it's going to happen. Cool. All right, over on TikTok, MRB 1004 says gas prices always go up when things happen in the Middle East. Yes, that's true. It happened in the early 90s. I have a YouTube video that's up right now. Go over to YouTube and check it out. Save it, put on your watch later list. You should watch it. That's all about like placing this economic moment historically and conceptually. And what I landed on in that video is like this economic moment feels a lot like the early 90s. In the early 90s, we were also at war with Iran. That was the Gulf War. In the early 90s, we also had this transformative technology of the internet emerging, but people were still skeptical at that point. It hadn't been like deployed to the masses or utilized by the masses yet. And that it feels like, history doesn't repeat, but it does rhyme. Kind of feels like the early 90s, gas prices being up and us at the very early stages of a technological revolution. So it's happened before. Conflict in the Middle East leads to higher oil prices, leads to higher inflation. And in the past, it's been more severe because we weren't as able to navigate around oil as an energy source. Now we have more energy alternatives, but I'll say that in the past when it's happened before, it's been painful before too. So that's not new either. MRB also asked, who's going to buy the homes if the rates go up? Well, there'll be less people to buy homes if rates go up. As we can see, just like in the most recent data, that when rates went up, buyers backed off, less sales happened. So yeah, it slows down the housing market anytime that rates go up. And someone said, Tom Dick said, you work for Redfin. Can I blame you for my tenant having spilled milk in their fridge? No, you can't. I'm not involved in that. I don't have anything to do with you or your tenant. MRB 1004 on TikTok asks, what do you think about home sellers selling their home for AI shares? I talked about this a couple of weeks ago on my live stream. Let me click over. I got some AI stuff planned. Let me see if I can find a good image to go with it. Oh, is it over here? Oh, yeah. Okay, so the AI money is definitely influencing the Bay Area housing market. There was a report in, let's see, the New York Times about how hysteria grips San Francisco's housing market as AI wealth pours in. We've been reporting on this over at Redfin. I think we were one of the first people to spot this trend of AI money resulting in bidding wars and prices being bid up, especially in luxury neighborhoods in the Bay Area. And it just keeps going. I think that we're like at the beginning of this trend in the Bay Area of AI money really meaning a lot of money flowing into real estate. And the reason this is happening in the Bay Area, well, one, it's because there's a lot of tech workers in the Bay Area. These AI companies are located in the Bay Area, but the Bay Area is notoriously bad at increasing its supply of housing. So whenever demand for housing increases in the Bay Area, it pushes up home prices more than it would in a place like Austin that builds a lot of housing. So this frenzy, it seems like this is going to be a longer term trend. I mean, OpenAI and Anthropic haven't even gone public yet, but we estimated that OpenAI and Anthropic employees could buy nearly 1/3 of all homes, not even homes for sale, all homes in San Francisco with their IPO earnings. So it's just with this, I mean, they're not literally going to buy 1/3 of homes. Like, why would they do that? But they could. they have the money to do it. I mean, it probably was all the prices going up. And you have to readjust the math. But the point is that like this is a crazy amount of money that is being generated by this AI boom for the employees of the companies. Potentially, they haven't IPO'd yet, so we'll see what the exact numbers land on. But it's not crazy that it's not like a crazy connection to make to higher home prices, that all this AI money is being generated in the Bay Area. It flows directly into home prices because we do not build homes in the Bay Area, not as many as we need to. And this is like a huge, huge windfall, not only to the open AI and Anthropic employees who are getting these shares, these IPO shares, it's a huge windfall to every single existing homeowner in the Bay Area. Because these homeowners, their property taxes are capped. They cannot increase by more than 2% every year. So if their home, let's say, were to double in value, they get to like retain all of that without having to pay much additional tax at all. Like their home could double in value and they'd only have to pay 2% more property taxes. So this is like a huge amount of wealth that goes into homeowners who really didn't do anything to make AI. You could just be a homeowner, retired potentially, not working at all, and you're richer now because of all of the technological innovation coming out of the Bay Area, because you happened to buy a home in the Bay Area before that technological innovation happened. You didn't actually do any of the innovation, but you get rich off of it, which is why we should probably get rid of Prop 13 in California. But, I could go on and on about that forever. All right, Greg asks another question. You don't have to say sorry, one more question. Keep them coming. Please keep them coming. I might not answer all of them, but I appreciate all of the comments and questions. Okay. Any thoughts on Bitcoin counting as collateral for a down payment? Is a new FHFA initiative, and I believe this approved mortgage was just completed last week. So, okay, the other question on TikTok was about like sellers themselves accepting shares in private AI companies that have yet to go public. When that happens, that's really just on the homeowner themselves to make that determination. Like, it's a free country. I could sell my home for Pokemon cards if I wanted to. No one's going to stop me from doing that. If I'm willing to accept Pokemon cards as payment, totally legal to do that, totally fine. Where it becomes an issue of government regulation is if you want to go to a lender and put up your Pokemon cards as collateral for getting a loan. And maybe I'm being purposefully disparaging of Bitcoin because it's probably about as good of an investment as Pokemon cards, in my opinion. But nevertheless, it's not that they're using that as down payments. The lender is not going to accept your Pokemon cards or your Bitcoin as a down payment. But what they are going to do now is they're going to consider it when determining your ability to pay your loan. So the same way that they might look at the fact that you own a car, or actually as a car one, they don't consider cars. Currently, the way it works is that they look at your stocks, and you can count stocks as collateral, meaning that they might like assume that you can pay back your loan if you have, let's say, $100,000 in the stock market. And any stock counts. Like if I have all my money in I don't know what's a publicly traded company that's kind of ridiculous. I'm trying to think if there's one. I'm not thinking of a good metaphor right now. Let's say I have all my money invested in Red Lobster. I'm not sure if Red Lobster is public or if they're a subsidiary or somebody else. Let's say I have $100,000 in Red Lobster stock. The bank will count that because they will say like, okay, she has all this Red Lobster stock. If she can't pay her mortgage anymore because she gets laid off from her job, she will be able to sell that Red Lobster stock and keep paying her mortgage. Therefore, we're going to give her a better interest rate. I don't think that like Bitcoin is inherently more risky than holding all of your money in Red Lobster stock. They both could go to zero. So it doesn't bother me that the government is going to allow lenders to consider Bitcoin stock and treat it the same way that they would treat any other stock, because they're still going to discount it based on its risk, based on the length, based on like the the history of volatility in Bitcoin stock the same way they would look at the history and volatility of any individual stock. They're very risky individual stocks. They're penny stocks. So I think it's fine to say lenders like, okay, you can treat these cryptocurrencies the same way that you would treat any other stock asset. Doesn't bother me at all. It's not really going to change the kind of home that they could purchase, but maybe they'll get like a teeny tiny little slightly better rate if they can put up that Bitcoin as collateral. I think what does it legitimizes Bitcoin, and maybe you don't want Bitcoin legitimized for reasons. There's lots of reasons to think that Bitcoin shouldn't be treated legitimately. But from the perspective of like how much risk this is going to inject into the housing market, I don't think it's going to really inject any risk at all. Sounds like a similar structure to borrow on margin from your broker. Kind of. I mean, like you don't have to go to a mortgage lender to get the money to buy a home. You could go to some private lending market. You could go to an individual. You could go to your friend and say like, hey, I have all of this Bitcoin. I have $1 million in Bitcoin. Will you lend me $500,000 to buy a home? And if I don't pay you back, then you get all my Bitcoin. You can write a contract like that with any individual, with any private company. But that's not a mortgage loan. You're just borrowing money from, it's like any other loan. It's like a personal loan. But you can use the money from a personal loan to buy a home if you wanted to. You just probably have a much worse interest rate if you did that. The conventional housing market is subsidized by the government. So you're better off most of the time going to a mortgage lender instead of to some other lender to get the money to buy a home. Okay. MRB says he's from SF. Cool. What do you think about, okay, you already said that. Okay. Cool. Any questions? JT says prices are increasing in Miami. Oh, I have stuff to talk about with Miami. Maybe I should just bounce around as you all ask me questions. Should I talk about what's happening in Miami right away? I kind of I can go in reverse order. So I found this we did this report on Redfin recently. We put out this week about how luxury homes cost 9 times more than typical homes in South Florida wealth magnet metros. That includes West Palm Beach. In West Palm Beach, the typical luxury home costs nearly 9 times more than typical non-luxury home. In Miami, it's 8.8 times. So the way that we define luxury in this analysis is the top 5% of the market. So what we're finding here is like, you know how there's wealth inequality? You always hear about like the 1% earns 9 times more than the average US American. I think that's the stat. It might be out of date, but I think it's something like that. Like the 1% earns 9 times more than the average person. You can do that same kind of comparison for home prices. So let's see if we have it here. So in the most affordable places, the smallest premiums. Okay, in the places with the smallest premiums, for like Portland, Oregon, for example, homes that are priced in the top 5% only sell for 2.6 times what the median home price is. So you could be buying one of the 5% most expensive homes in Portland for $1.5 million, which is only 2.6 times the median home, which is $553,000. When you go over to Miami, West Palm Beach, the difference is way bigger. So the most expensive homes in West Palm Beach sell for $4.5 million compared to the median of $506,000. In Miami, it's 4.855. I'm going to be, rounding a 0.55 is always like, which way do I go? I know the rule. This technically, I can round this up to 4.9 because there's a 5 followed by another 5, but this 5 is followed by a 3. So I think that means this is 4.8, not 4.9. I'm sorry, I'm doing a math glitch. I do math glitches sometimes. Let's just say $4.855 million, which is 8.8 times $554,000. So there's this much bigger gap happening in Florida between the most expensive homes and the median priced home, which is way bigger than what you see with the smaller gaps. Like Portland, it's a 2.6 gap, Sacramento 3, Columbus 2.9. And I find this so interesting because of one, it's the climate implications. Like I could definitely foresee that in Florida, especially these coastal Florida, like vacation destination, wealthy destination areas, that extremely wealthy people are not at all deterred by climate change when it comes to deciding whether to buy a home there. We just saw that, what his name is, Griffin, the billionaire Griffin. I know this because he donated a bunch of money to U Chicago, my alma mater, to name the economics department after him. I think that's him. So he bought a bunch of real estate in Florida. He's building a whole corporate residential complex down there. And it's like, wow, that's so interesting. Doesn't he know about the flood risk? Does he know about the climate risk? Well, he's a multi-billionaire. So he knows, he doesn't care. I think that's generally true for the wealthy, that they know about the climate risk. They do not care because they have the money to address it. They have the money to build homes that are resilient. They have the money to build a seawall. They have the money to pump out the water. They have money to pay for insurance, or they have money to go insuranceless if they can't get insurance and self-insure. They just have all the money. But the average person in Miami is probably, I know this because we know this from agents, our Redfin agents. Insurance is a problem for them. It does limit their ability to buy homes when insurance is high. It does limit their ability to buy homes when they're trying to buy a condo in HOA, and the HOA fees keep going up and up and up because the maintenance for that building keeps increasing because the building is old and out of date for the climate. So it'll be really interesting to see how this plays out over the next decade, really. But I could see this trend persisting, where luxury home values in Miami and West Palm Beach continue to climb to heights never seen before, and the median home value stagnates because regular people can't afford to live there. So it'll be interesting how that plays out. All right, Dr. April Barrage. Hi, April. You should go check out April's channel. She's an economist at Stanford. She says, it is so interesting. My lease renewal in Palo Alto was flat. I wonder why. Is it just SF seeing the surge and increase in prices? Yeah, so this is like, this has been happening more broadly, that rent prices have not been tracking with home prices. Part of the reason why is because there was a lot of rental supply built during the pandemic, multifamily, like one bedroom units, studios. So if you have a one bedroom or studio, you might not be you probably aren't experiencing the same level of inflation in prices compared to somebody trying to buy a 3-bedroom condo even, or a single family home. These are the kinds of homes that wealthy people who are getting a lot of money would want to buy. They're not going to be buying a 1-bedroom condo or apartment. They're going to be going big with all their big money. And when we did our analysis of the Bay Area, we found that the price increases were concentrated to the most affluent neighborhoods and the highest price points of homes. So again, it's this K-shaped economy kind of playing out. But another explanation mean that, like, maybe your rent didn't increase this year, but next year I would bet that it would, because I think it was Zumper, maybe it was Apartment List. They were reporting that they are seeing rent increases in San Francisco. Now, San Francisco is not San Jose, is not Palo Alto, but they are reporting like super steep rent increases in SF. So maybe this is more concentrated to the SF area, or San Jose, Palo Alto is just late and it's coming to them next. So if I were you, I would try to lock in a 2-year or maybe a 3-year lease if you know you're going to be staying put, so that your rent stays flat, even if there's a lot of pressure on rents in the next couple of years, if your landlord is willing to negotiate. A lot of people don't know that they can negotiate with their landlords, but you definitely can. One lesson that you should take in life, and maybe you should get from my book, is that everything is negotiable. Don't take no for an answer, kind of thing. Like, I feel like in America we're not conditioned to negotiate the way that people from other cultures are conditioned to negotiate. But one thing I try to do with my kids is I encourage them to negotiate, because I want them to have this mentality in life that they can always ask for better terms, better conditions, whether that's in the workplace or when it comes to income, when it's buying something. You got to feel comfortable negotiating. It doesn't hurt to try. Never hurts to try. People always think it's going to hurt to try. They're like, oh, if I ask for more money from my boss, they're going to think less of me. No, they won't. They're going to think that you are valuable, that you know something they don't about how valuable you are. So yeah, don't be afraid to negotiate. Practice. One way you can practice negotiating, I'm getting on a whole tangent about negotiating, is I started. There's this app called Poshmark where you can buy clothes from like third party sellers, and they encourage negotiation. You can like send them an offer. They'll list a price, and you can send an offer that's different from the price. So I use that app. I try to use it like pretty frequently just to get in the habit of like kind of testing. Well, how much can I negotiate? Like, can I ask for a 20% discount? You'll give me 10. Well, that's reinforcing this idea that everything is negotiable. I can always negotiate. So try to find little ways in your life to negotiate, just so you're in the habit of it, so you're not afraid of it, because you can always negotiate. Okay, enough about negotiation. Let me see. Am I a haggler? Is that a term? Yeah, I'm a haggler. I think that's the right term. I think haggler kind of has like a negative connotation, but I'll own it. I'm not afraid of being called a haggler. It probably annoys people sometimes, but again, they're just learning that I am the kind of person who knows my value, or who doesn't accept the first offer. Okay, cool. Let's move on. What else is going on? We talked about that. Okay, so back to what's happening in the housing market and the global economy. The Federal Reserve met. This wasn't a policy setting meeting. Oh wait, no, this was from the present policy setting meeting. Excuse me. But I guess the minutes were released, and it gave us more insight. Yeah, Fed releases minutes about what the mentality was in that meeting. Now, this was before. This meeting took place. Does it say June 16th to 17th? So this is a bit dated. This information that we're now getting, but what we're learning is that there were a couple of people who did want a rate hike, but there were enough people who didn't think that it was necessary just yet. Now, I think since then we've gotten some more data about jobs that show the job market. I don't know. The job market data actually didn't really show anything interesting at all, or anything meaningful. But okay, here's what I want to say about this. I think that the Fed is postponing the difficult decision of raising rates. I'm kind of more in the camp of Bank of America and some of these other analysts that inflation is sticky. I mean, we've had it. It's been here for 4 years now. We've been above the Fed target. I think that there was this hope casting that happened in 2022 and is happening now, that inflation is transitory, and if we just get through it, then inflation is going to come back down to target, and we can lower rates, and everything is going to get back to normal. But I put out a YouTube video that kind of explains this framework for how I think about where mortgage rate or interest rates and inflation and growth are headed. Please check it out, because I go through this whole graphic in detail. But the general gist of it is that I feel like we're kind of stuck in this orange region right now, where we have high growth in the economy, but we also have high inflation. And the things that are contributing to that include the construction of data centers. That seems to be inflationary. It's inflationary in terms of like the physical materials to build that. And it's also inflationary because of the energy resources that these data centers take up. I have this extinguisher here. This is about like all of the investment we're going to be making into solving problems that have come to roost. So that includes climate change, like fire, like literal fires. That's what the fire extinguisher is supposed to represent. But there are other things that we've been ignoring that are going to come to roost, like our crumbling infrastructure. That's one. The Colorado River is drying up. That's another. So there are these problems that we haven't been very good at addressing that are going to start to cause problems in the economy. And the reason why this increases growth and inflation is because you have to hire people to solve these problems. In the fire example, you have to hire firefighters to solve these problems. You have to buy fire extinguishers, and that all contributes to GDP. So it does increase growth, but because we have a limited supply of money in the economy, or we have a money supply, if more of that money is going into solving problems, that means that we're having to spend money on things that are not actually making people's lives better, and we're taking resources to solve these problems, and that is inflationary. And they also have this windmill here because we're going to have to be starting to make some tough choices about the climate. The windmill kind of represents this idea that if we get off gas, we're not really ready. We don't have enough alternatives that are better than gasoline yet, that are cheaper than gasoline yet. Wind is carbon neutral, but it is less efficient from an economic perspective, not from a climate perspective, than gasoline. So that in itself is inflationary. So I see these problems like sticking around for a while. And if you want to learn what happens in these other quadrants that get us to lower interest rates down in the bottom left versus higher interest rates down up in the top right, go check out my YouTube video. It's called Economic Eras, because I did like a little Taylor Swift metaphor here. There's a couple Taylor Swift jokes in there. That's why I called this Economic Eras. But just go to my YouTube channel if you want to see it. But back to the Fed. I'm increasingly feeling like inflation is going to be stickier than what I previously thought, than what other economists previously thought. Part of it is just that like it's been around for too long, and now the war in Iran is inflationary, but the war in Iran is not resolving, and maybe this is the new normal in terms of global politics and trade. I have down here trade breaking down, reducing growth, and also being inflationary. You could put war here too, but just like a lack of global cooperation, that can lead to more inflation. It can also reduce growth, which complicates the mortgage rate perspective. But they're just these things that I think people aren't giving enough weight to, and I think the narrative has been that once the trade war, we get through this tough period of higher prices from the trade war, we get through this tough period of the conflict in Iran, then things will go back to normal. And I'm starting to feel like, no, like us having these problems is the norm now until we get better at solving problems, until we get really good at solving problems. So good at solving problems that we get to a place where we're even better off before we had the problem in the first place. Great. Thanks. April says that my book is great. Highly recommend. You heard it from Dr. April Barrage, Stanford economist. Check out my book. Let's see what other comments we got. Is this economic eras reflective of American or global? That's a good question. So in my video, I do a very US focus, but really this framework works better at a global level because like I'm not really getting into trade here. So I have Africa in the middle between low inflation and high inflation. From a global perspective, Africa will increase growth. I assume it's going to increase US growth too. And when I say Africa, what I mean is that there are 1.7 billion people in Africa that are mostly teenagers that are going to be entering into the economy, and they're probably going to make more money than their parents did and be a bigger force in the global economy. And that will lead to global growth, probably US growth too, because some of those young adults in Africa will be buying US goods. They'll be consuming things that the US produces, so that will lead to growth in the US. But they also might make more things expensive because then the US consumer is competing for goods and services with the African consumer. Now, when China entered into its economic growth period, they were a huge producer of US goods, so that drove down inflation in the United States. But I don't know if Africa is going to be like a producer of goods to the US specifically. They'll probably produce stuff for the global economy, but it seems like China is really like investing a lot in Africa for their own economic objectives. So that can mean that Africa entering into like a more developed stage in the global economy might be better for China's economy, helps it grow without inflating it in a way that doesn't do it for the US. So I call this like economics astrology because it does get into astrology when we start trying to forecast the future. But what I try to do in this video is really tell you what my framework is, that you can take my framework and you can say, actually, I'm going to tweak it. So I think that Africa is going to be disinflationary, and I'm going to move Africa into the green quadrant. Or I think that AI is overhyped and that we're not going to be getting to this place of higher growth and lower inflation where goods are produced cheaply because of AI. So you can kind of downweight that. You can take this framework and you can come up with your own forecast for where you think rates or the economy are headed. But yeah, go check out that video. Okay, any other questions over here? Someone asked what happened to American jobs coming back. So far, the evidence seems to show that they have not come back. Uh, it takes a while, to be fair, for manufacturing to come back to the United States. It seems like we're manufacturing a lot of data centers. We've got data center jobs out there for the very limited number of people who are qualified to build data centers. But if it were to be sustained, then that would create we probably start training people to build data centers and create more of an economy around it. But for the time being, it's not a huge driver of jobs because there weren't people working in those industries in the first place. So anyway, US jobs coming back. Maybe we'll get some more manufacturing jobs of data centers in the future, more jobs for firefighters, more jobs for wind turbine makers. But I don't think that we're going to be making iPhones in the United States anytime soon, or probably ever. Okay, what else did I want to talk about? Oh, back to data centers. Yeah, so I talked about this a little bit, but story out about how US power companies are scrambling to secure equipment as surging data center demand strains supply. So this is how data centers and the AI boom can be inflationary. So I think when we talk about the AI boom's impact on the economy, we have to kind of, distinguish between the period that we're in right now, which is one of investment, and the forecasted or the projected future when all the data centers are online and everybody has AI, everybody's using it. Right now, a pretty small share of Americans are actually using AI on a regular basis. Companies haven't really figured out just yet how to deploy AI in a way that makes them more productive. So we're in this phase of investment without actually reaping the benefits of that investment. And see, this framework is so useful. As I talked about in this framework, that means higher inflation. Higher inflation for now as we're building data centers with the hopes that one day we have AI that truly is making the economy more productive that brings down inflation. But for the time being, it is definitely inflationary. There's a shortage of power transformers. There is a increase in the price of electrical equipment, and also utilities themselves. So these data centers use up a lot of energy, and energy is a marketplace. If you're on a grid, then everybody on the grid is competing for energy with you, and if the data center's on that grid, then they're competing too. There's not really a way around that besides subsidies or taxes, which you probably will be doing and should be doing. Unless you're a huge AI bull and you're like, no, we gotta let these AI companies rip because we're all gonna be better off because of it. But jury's still out on whether that's gonna happen. Just subscribed, yay, to I Really Want to Know podcast. Can we expect a big correction in the housing market due to the low jobs and wages? Okay, so let me see if I can show you the map of prices. We only have these ones? Okay. So let me go to the data center. It'll be better there. We have this beautiful data center where anybody can look up data on their local housing markets if they want to. You can download the data, you can plug that data into Cloud Code, and you can make your own beautiful charts. And you can do your own housing market analysis. I'm empowering you, or Redfin is. Okay, anyway, sale prices. Okay, you're asking, I Really Want to Know podcast is asking, can we expect a big correction in the housing market? If we were going to have a correction in the housing market, it would have happened in 2022. That's when mortgage rates spiked and went from 3% to nearly to 6. I think it went to 5% at first, and then up to 7%. And there was kind of a correction that happened. There was kind of a big drop in 2000 in May, or yeah, in this is ending June. Okay, in June 2022, the median home price was $380,000. And by January 2023, it was down to $340,000. And since then, home prices have been going up. Now, they've been going up slower than the pace of inflation. So if you adjust for inflation, you would see that home prices came down and they've stayed down. But because, money supply, interest rates are still low, the Fed needs to hike. The Fed's got to hike, right? I don't literally. I mean, no, you heard what I said. The Fed's got to hike, right? Because there's the economy is inflationary. Prices are continuing to increase, even though there isn't more demand now than there was before. There's less demand. And the reason why there's less demand, did I zoom out of that? Let me go back. Is because if you look at mortgage payments, so this is just for here. Anyway, I'm not coming up with a good visual just yet, but mortgage payments are way, way higher than they were back in 2022. So the cost of owning a home as a borrower is way, way higher, but the sticker price, like if you're paying in cash that has been invested in an asset, like let's say you had your cash in a high yield savings account with an interest rate of 3%, it is now more affordable for you to buy a home with that cash because the prices come down relative to how much your money has gone up in value. But for people who are borrowing costs have gone up and it's become very unaffordable to buy a home. And you're asking if there's going to be a correction. I would say my answer is the correction is happening, but it's not a big, it is big in a certain sense, but it's slow. It's very, very slow, and you can't even see it when looking at nominal prices. You have to adjust for inflation to see it. And it will probably last a decade of prices going up slower than wages. So the correction is happening. And supply is slowly increasing. You guys are you all are predicting what I'm going to talk about, which is great. We're on the same wavelength. We're vibing here. So one of the stories I have pulled up to talk about is that boomers, they're going to be passing down a lot of homes. Some of those homes are going to go directly to their heirs. And according to the Washington Post, many of those heirs are already rich to begin with, because if you come from a family that has wealth, you are going to be wealthier yourself. There's economic research. Shout out to this paper by Kerwin Charles, Eric Hurst. I think it was just Kerwin Charles and Eric Hurst. I don't think there was a third author out of the University of Chicago that showed empirically that if you are born to a family of homeowners, you are more likely to be a homeowner yourself, and you will be wealthier than somebody who didn't grow up with homeowners as parents. So again, not surprising that like this is reinforcing wealth inequality, this transfer of wealth. But regardless, I think a lot of the heirs are going to be selling these homes. Some of these homes, maybe they don't have any loans on them, they just get them straight up. But unless they really love the home, they're probably going to sell it, because these homes are probably located in places that their heirs don't want to live. Or maybe they're out of date, they need a lot of maintenance, and the heirs aren't going to want to deal with the hassle of updating the home. Some of these homes will have mortgages on them. Some of these will have reverse mortgages on them, so their heirs like have to sell unless they want to pay off the debt. So we are going to see a lot of homes for sale as baby boomers retire. I don't even want to use the term retire, because a lot of baby boomers are going to age in place, and they're not going to give up their home until they pass on. I can kind of like come up with like a better way to say this. I don't know why I can't just say they're going to die. Can I just say they're going to die? I'm not being mean. It's just a fact. When these baby boomers die, many of these homes are going to be sold. I think a lot of them are going to be sold to developers. And I know that's going to piss people off. I've already seen people calling this out. Oh, it's all going to go to private equity. I don't think it's really like a private equity thing. Like whether it's, I don't get why the distinction matters. They're going to be sold to private companies though. Probably developers that are going to turn these baby boomer single family homes, especially in places like Los Angeles or the Bay Area, into multifamily housing, because they will be able to get a high return on investment, because there is so much demand for affordably priced homes. There aren't a lot of people that are going to be able to buy these McMansions at these interest rates. But if you demolish the McMansion and you build 8 units at, it won't be an eighth of the price, maybe a quarter of the price, more people can afford that, even at these interest rates. So I think that's what's going to happen. And that will bring down home prices. The median home price, like mathematically, is going to go down. But part of it is going to be that we are increasing the supply of housing, and we are increasing the supply of housing at more affordable entry points, denser housing, smaller housing that doesn't take up as much land per unit, that allows the price point to come down. So that's like the bigger trend that we're going to see. It'll probably take like 2 decades, I would guess, but it's started. It's starting. It's already starting. I really want to know podcast over on YouTube asks, I'm in Tampa. It's getting bad here, but there's so many opportunities if you have capital. I guess not a question. But yeah, interesting. If you want to elaborate on that, I really want to know podcast about what you're seeing in Tampa. let me know, because Tampa's an interesting market. It's much more affordable than Miami. So as people get priced out of Miami, they might go to Tampa, still stay in Florida, not leave the state entirely. Oh, you bought my book. Thank you. Yay. It's only $3 on Amazon for the Kindle edition right now. $2.99 for the Kindle edition. So they go on sale. Like I try to check the price every so often, and I've noticed that like there are these kind of sales that I guess happen. So right now it's on sale. You get the hardcover for I think $9 right now. So go get it. And the audiobook is also for sale. It's a little more expensive. I think it's like whatever a credit is on Audible. But I narrate the audiobook, so that's worth the value, right? You want to hear my personal narration? But I don't really care. I don't even care if you get it from the library. It's available at the New York Public Library. I went to New York a couple weeks ago, and I made a point that I looked up if my book was in the library, and I went to the main library branch, where I discovered that there's like the museum library, and then there's like across the street the actual flagship library where you can check out books. And I went and I saw it, and they had supposedly 2 copies, but one was checked out. So go get it at the library if you want. I just want people to read it and share my art, my economics art with the world. Sometimes I think of myself as like am I an economist or am I an artist who makes art about economics? I'm probably an economist. I'm not like that. My identity is not really wrapped up in being an artist as much as it is wrapped up in being an economist. So that's probably what's going to win. But I'm more of an artsy economist, if that makes sense. All right. Somebody over on TikTok disagrees with the comment on YouTube. They say that Tampa is bad right now because of the storms. Let me see. I got to back up to read these comments. West Palm Beach, they're probably paying cash. They don't have to worry about the interest rate. Yeah, a lot of these like more affluent Florida buyers, I'm sure, are paying in cash. Maybe and they just don't really have as much price sensitivity. Okay. Any comments over on Instagram? JT1963 got the audiobook. Yay. All right. What are your thoughts on proposed elimination of property taxes being eliminated in Florida for homeowners? Says JT1963. Yeah, you were. I'm telling you, we're on the same frequency. Me and all my live stream friends. Where did this story go? I could have sworn I put it in here. Oh, here it is. America is in the middle of the biggest property tax revolt in 50 years. Now, so home values went up a ton during the pandemic. Mortgage rates dropped to 3%. Everybody who could buy a home did buy a home, bought multiple homes, second home purchases increased, investment home purchases increased. People who already owned homes refinanced their mortgages, and there was this big boom in the housing market. And property taxes are a bit slow to reset. Like they don't, sometimes there's a delay between when your property goes up in value and when your property tax assessment increases, because those tax assessments happen on like calendar schedules. You know, they're based on comp sales, and like they can just take a long time to filter in. So I think what's happening now with this property tax revolt that's happening is that it is a negative reaction, a backlash to the increases that are happening because of the increase in values during the pandemic. But what irks me about this property tax revolt, okay, let me see. Home equity, United States. I think this is the New York Fed that has this data. Here we go. No, I don't want debt balance. Okay, maybe it's not the New York Fed. All right, households owner equity in real estate. Look at how much, let me go 5 years. Oh, the pandemic was so long ago. Okay, look at how much home equity increased during this time. Because, okay, your home value increased. Your taxes are going to go up because your taxes, actually, not necessarily your taxes are going to go up. People's property taxes are going up, okay? It's because their home values went up, but their equity also increased. The wealth that they have, maybe it's just on paper, but the wealth that they have access to, if they wanted to go refinance their mortgages, if they wanted to take out a HELOC, has increased substantially. Home equity in the United States went from 19.5 million, or let's go back. 19.1 million in Q1 of 2020. It shot up to 32 million by Q2 of 2022 and now stands at 35 million as of Q1 2026. So a vast amount of wealth was created during the pandemic that is being stored in homes. Okay? And everybody talks about a wealth tax. The only wealth tax we have in this country is the property tax. But people are mad that they got wealthy and now they have to pay higher property taxes. And that is why we are seeing a tax revolt, because people are mad that they are being asked to chip in more now that they have become much wealthier as homeowners, assuming that they own their home, pre-pandemic. There's been a lot of talk about like, well, senior citizens, they're on fixed incomes. They can't afford these higher property taxes. They could sell their homes. You know that baby boomers own more 3-bedroom homes than millennials, Gen Xers, millennials, or Gen Zers who have kids. See, like childless baby boomers own more 3-bedroom homes than families who have kids. So a lot of these baby boomers are sitting on homes that are too big for them, that have gone up in value, but they don't want to pay higher property taxes. They're crying poor that they can't afford higher property taxes. It would be like if I was sitting on top of a treasure chest, and then you come to me and say, like, can I borrow 20 coins? And I say, sorry, I can't afford it. I have to keep this treasure chest locked forever because this is where I sit. That doesn't make sense. So I think property taxes can be good for the economy because it helps people move on from homes that they don't need anymore. And it also is a way to redistribute wealth, because if you have a very expensive home, you are by definition wealthy, and you should be chipping in more to pay for local resources. Ideally, we would have land value tax instead of property tax, because the downside of property taxes is that it discourages development of homes. Like if I want to build an ADU, a backyard cottage in my yard, I might not do it because I know that my property taxes are going to go up because I'm increasing the value of my home. So I don't think we should tax people more for creating more housing. That is not what we should be doing when we have a housing shortage. But we should be taxing people more when their underlying land in their homes goes up in value, because they are wealthier. They got wealthier and they didn't even have to do anything to get wealthier. All they had to do was own a home and sit tight and wait for it to go up in value. Now they're wealthier, and the downside of being wealthier is you have to pay your taxes. You win the lottery, you have to pay taxes on the lottery proceeds. This is just how it works. But we'll see. It's so interesting because I saw that congressional candidate from the DSA, I think his name is Abdul Saeed, was saying that he was going to freeze property taxes. But then you also have Ron DeSantis saying he's going to freeze property taxes. And it's like, I guess, horseshoe theory, right? Like the far left and the far right agree that we should be freezing property taxes. But I'm telling you that, there's nothing wrong with property taxes. And this revolt is people who are very wealthy getting mad that they don't want to pay more taxes now that they've become wealthier. Okay. Yeah, and I think, okay, to give the baby boomers, I Really Want to Know podcast says, yes, they can sell. Breaking Points was talking about the senior tax thing yesterday or today. Florida, Michigan, Ohio politicians are all talking about this tax thing. Yeah, they can sell. I guess if I'm gonna be playing devil's advocate, they don't really have a lot of good options for where they could go. I've been talking to my dad a lot about this, about how like if he sold his house, he's like looking through like, okay, where would I move? And because he lives in Los Angeles, there like aren't dense housing options to begin with for seniors or for anybody. So like, what can you do? If you want to stay put, you're just going to be trading one neighborhood for another neighborhood. I think that if we want to prevent these property tax revolts, we have to give people who say they can't afford to stay put a good option for where they would move next at a more affordable level for them. Like it would be great if we could get these seniors in 3-bedroom homes into retirement complexes where, there's elevators, There's a shuttle that takes them to the doctor or to whatever activities they want to go to. There's a rec room for them to interact with one another. And these things exist, but they're extremely expensive because there's a shortage of these types of senior oriented housing developments. But we need more of them. And like, I get it. I get that, why some people who are rich on paper do not feel like they are rich because they do not have the options that being rich is supposed to provide to them. I understand that. And I think that's a problem in our economy that we should be actively trying to solve. All right, what do Ethan Flynn over on YouTube asks, what do I think about higher property tax rates for second homes and investors? I think that they are inferior to a land value tax. I think a land value tax would work better and incentivize better behavior. Excuse me. The reason why I think that taxing second homes and investors is inefficient compared to a land value tax is that, well, one, you can get around it. So if I have let's say I live in Long Island and I have a pied-à-terre in New York City, and New York City is going to tax pied-à-terres because they're going to look at my records and see that I own 2 homes, and they're going to say the second home gets taxed more. Okay, I'm married. Maybe I'll put in my husband's name. Maybe that will get me around the rule. Okay, if that doesn't get me around the rule, maybe I'll put in one of my kids' names or put in my mom's name. And I can probably pretty easily navigate around the second home tax while still maintaining the same usage of the home that I was intending to. So I don't think they work very well. For investment properties, taxing investment properties, I think there's a way you could construct a tax on investment properties that works kind of like a land value tax. Like maybe you tax, instead of having a rent freeze or a cap on rents, I would be more in favor of, okay, we're going to tax you a percentage that corresponds to how much you increase rent for your tenants every year. So like, let's say that if you do a 10% tax hike on your tenants, we're going to treat that 10% increase kind of like the way we would treat capital gains, and we're going to take, I don't know, 30% of it as taxes. So let's say you charge a tenant $1,000 and you increase their rent to $1,100. Now you get taxed $50. I think that could work. I haven't really thought it through yet, but I kind of like that. Maybe there's a way you could do an investment tax that kind of back engineers a land value tax, because the reason the rent increases if the landlord isn't actually doing any improvements on a unit is because the land has become more valuable. So maybe there's like a way you could kind of like backwards get at that. Okay, I just want to check my calendar because I'm going over time, but I don't know, I'm having fun, so I think I might just keep going until I run out of stuff to talk about. Nope, no meetings. So I'll just keep going for a little bit. Dr. April Barrage says San Jose has a grandfathered rate for property taxes for some houses. Do you think that helps seniors? I mean, it helps them stay wealthy. And that's like, so, oh man, it makes me feel like actually pretty bad that they're doing that, because California already has Prop 13. Taxes are already capped. You can't increase taxes by more than 2%. So if San Jose already has a grandfathered rate for property taxes for some houses, then that means that like their taxes are increasing even less than 2%. And they're able to acquire all of this AI wealth without having to pay tax on it even more so. I mean, I'd have to look into how it actually works, but it doesn't sound like something I would like, that I would support. But yeah, it probably helps seniors. But seniors who own homes in San Jose are some of the richest people on earth. Like, we always talk about Elon Musk being so rich, but these seniors in San Jose, they're like of a class of people that are the 1%. I have to do the actual math, but I'm pretty sure they're part of the global 1%. So they probably don't need much help, even if they say they do, because they could sell and make a lot of money. Go move to Arizona, Florida, Sacramento. But like I said, we don't really give them options that they want to take on. So we got to fix that. All right, I really want to know podcast asks, the Midwest or the South could be an option. Condos are more affordable, but don't buy a condo here in Florida, LOL. My mom owns a condo in the Midwest. I wouldn't say it's like the best investment, but she likes it and she lives in it. The reason you should buy a home if you're actually going to live in it is for the value of living in it. If you're going to be an investor, you're doing different math. But if you are going to be living in the home, you should be buying it because of the consumption value that it brings to you. And the investment value is that your rent isn't going to increase. But I think that you should put first and foremost your own value on it, because the longer you stay in a home, the more time you'll have to accumulate equity, and you won't have transaction costs from buying and selling a home. And the more time you sell, and therefore, if you want to be buying the home that you will stay in the longest, you should be buying the home that you like the most, that you would want to stay in for the longest amount of time within your budget. Yeah, I really want to know podcast says, yes, they are. Most Americans don't understand the amount of wealth in California. And back to this article about, where was it? I'm forgetting which one it was. Boomers' massive wealth will mostly be passed down to people who are already rich. A lot of this massive wealth is concentrated in California homeowners. And I don't think some of their kids probably don't feel rich, but they are about to become extremely rich. And if they are living outside of California, it's like, they're going to be getting multi-million-dollar homes that they can go buy, 7 homes with in Ohio if they wanted to. I mean, I'm one of these people. I grew up in California. Went to Santa Monica High School, and now I live in Wisconsin, about 2 hours north of Chicago in a resort area. And things are much, much cheaper here than they are in California. And as much as I have nostalgia for LA, I'm going to be visiting LA later this summer. It's just not worth it. Now that I've left California and lived in many different cities, I can see that it's so expensive, and it's unjustifiably expensive. And then you also have traffic, which is a tax on your time. And then you have also air pollution and wildfires, which is our other types of taxes on your enjoyment of living in a place. But there's lots of things I like about California, and I understand why some people prefer it over anywhere in the world and would pay lots and lots of money to live there over anywhere in the world, which is why we should be building way more housing there, because so many people want to live there. And when demand is high, you want to also have a high supply. Lives in California, I'm rich. Yeah. I mean, by that global perspective, I'm not going to fight the I'm rich on a global perspective allegations. You can read my book and say exactly how much money I make, or not exactly because it's a bit out of date. But if you read my book, you'll find out how much money I have at different points in my life. I'm an economist. A lot of people feel uncomfortable saying it. I'm not going to say it right now because I want you to buy the book. So if you want to know how much money I make, you got to buy the book. Or how much money I made in 2022, you got to buy the book. It took me a long time to write. It's already 2026. I can't believe I wrote it 4 years ago. It came out only last year in 2025, because it took me a year to write it. Oh, no, it took me 6 months to do the first draft, but the editing took so long because I went through an academic publisher, the University of Chicago Press. It had to go through economic review. So 6 months to write the book, 6 months with my editor polishing it, and then it went off to academic review. Because academics are like the turtles of the world, it took another 6 months. I think it took 8 months to get it through academic review. And by that time, the earliest slot we could get in to release was April 2025. So even though I started writing in 2022, so it's all of my personal details are up to date up to then. It's been quite a long time, but books, they're forever, right? I'm still talking about it. Okay, what do I think about Kevin Warsh? This is what I think about Kevin Warsh. There was a lot of concern that he was going to do President Trump's bidding. President Trump said many, many times that he thinks that the way to make housing more affordable is to lower interest rates. He wanted Powell to lower interest rates. He talked about it a lot. So there was concern that Kevin Warsh was just going to do what Trump wanted, and lower interest rates. But he, historically, if you look at his writing, which I've read all of his Wall Street Journal op-eds from the last 6 years, he's very hawkish. He thinks that the Fed was too slow to increase interest rates post-pandemic. He was very critical of the Fed doing so much quantitative easing during the pandemic. He basically is errs to the side of higher interest rates, less money going into the money supply, which is the exact opposite of what President Trump was wanting out of Jerome Powell. But during his first meeting, he seemed to, signal very definitively that we are getting the OG Kevin Warsh, that he has not changed. He still is a hawk. He's standing by his hawkish principles. And even if I might not be as hawkish as Kevin Warsh, I respect that he is standing on his principles. So I think he's going to be fine. I think we're going to be okay on the Fed. I think that the Fed is going to remain independent, and that is good for the economy because that's what you want. You want a Fed that is really thinking about what is best for the economy, and you can disagree with their approach, but as long as they have that intent, I think we're going to be okay. All right. Thanks for all the comments, MRB 1004. Too many for me to see where the questions are, but lots and lots of comments. So thank you for that. I appreciate the engagement. Hey, I see some people also joining on Instagram. All right. And Randy Thomas asked, how do you think AI is going to affect areas just outside of San Francisco and Silicon Valley, such as the East Bay? I think that, so my impression, I'll go back to my visual before I start talking. So this is how I think it's going to play out. This is my forecast. Again, this is like economics astrology. It's based on my thinking, but I usually have a pretty good framework for how I think about things. I'm not just going off of nothing. I'm going off of an economic framework. Okay, here's how I think it's going to play out in the Bay Area. Right now, there is a rush to buy homes in anticipation of these IPOs that are about to happen. Some people are using money that they got from working for these AI companies. Like, these AI companies are spending big on signing bonuses. We've heard that from agents, people in their 20s getting $500,000 signing bonuses and going out and immediately buying a home. That's happening. But then when I saw the story about how a homeowner is accepting AI stock, unvested, pre-public AI stock as payment, I'm like, oh, this is about hype. People are rushing to get in early before all of this money is unleashed on the market. And as Redfin reported, OpenAI Anthropic employees could buy nearly 1/3 of all homes in San Francisco with IPO earnings. Like, that is the scale of the wealth that is being created by these by these AI companies. Okay, so I think right now we're in the lead up to what is anticipated to be a larger scale frenzy, which accelerates prices even more in San Francisco. And once that happens, people are going to be selling. Some of those people who are selling in San Francisco, they might move over to the East Bay. They're like cashing out in a sense, but maybe they're not going to leave the SF metro entirely. Maybe they'll just go somewhere more affordable and take all that extra wealth with them. So, and some people who are renters, let me stop. Okay, so some people who are selling these homes are going to maybe move over to the East Bay. Some of these people who are selling homes are going to rent instead. And once they decide to rent instead, well, that's going to accelerate rent growth, which I believe Apartment List or Zumper, I forget which one, was reporting that rents have been skyrocketing in SF already. And when rents go up, then everybody starts getting priced out. Regular people working regular jobs, not directly benefiting from the AI money, their rent's going to increase, and then they're going to start looking at the East Bay. So all of this to say is that I think that give it, I'll say 2 years. You can check back with me in 2 years. I think home values will be increasing in the East Bay. Not as much as in SF because there's like a proximity factor, but it will start spilling over into East Bay. Now, the good news is that the East Bay did a good job of building condos and dense housing during the pandemic. They have like a higher vacancy rate because of that. So some of it, and maybe they'll build even more, maybe with all this extra demand in the East Bay, and the East Bay being more YIMBY than the NIMBY San Francisco, some of this will result in more supply, not just higher prices. But still, I think prices will probably go up in about 2 years in the East Bay, but it probably won't be as dramatic as in the core of SF. Okay. San Jose is also the highest price in the country. Yes. Last year we reported that you would need to earn more than $400,000 as a household in order to afford the median priced home in San Jose. It might be higher now. We don't think we've redone that analysis, but isn't that just so crazy? $400,000 just to have the median home, the mid home. Okay. I really want to know says, and the cracks in the private credit market worry me. I haven't been following the private credit stuff super closely. I read a couple articles where my takeaway was like, big whoop. Like, I don't see this as being. I didn't see it as being as scary as I feel like people have made it out to. But this isn't like really my area of expertise. So we'll see what happens there. But I'll just say like I haven't researched it too much. I didn't when I did read about it. I didn't really get why it was such a big story. What's happening in the private credit market? I guess it's like, yeah. I mean, people. It's like kind of when people ask me like, "Oh, are foreclosures increasing?" And foreclosures are now at the highest level in 7 years. But 7 years ago, it was 2019. Like that just means we're back to pre-pandemic levels. So sometimes when like I read these stories, I'm like, things are getting potentially worse. Don't disagree with that. But is it just us getting kind of back to some pre-pandemic trends? What's happening in private credit? I'm not sure about private credit. I can say that for foreclosures. But I just remember looking into what was happening in private credit and feeling like it wasn't like nearly as severe, obviously, as what happened during the Great Financial Crisis. I guess we could debate like when we really need to start getting super concerned. Okay. Professor Mark asks, are we due for a crash? I explained this earlier, but I know there's more people in the chat, so why not? I'll keep going. Or maybe I'll just summarize. I do not think that we are due for a housing market crash. I would say that we are currently already in a correction. So I'm bringing up median home sale prices. Okay. So home prices went super high back in 2022. Okay. And then they came down, but then they started going up again. But what you're not seeing here is that home prices have been going up slower than inflation, slower than wages. So in real terms, home prices are already correcting. It's just a very slow correction. And you can't even see that the correction is happening until you adjust for inflation. And a lot of people are like, oh, home prices are going to drop. It's going to be this big dramatic crash. When what's actually happening is that it is a sustained correction. It's a very slow moving correction that's going to play out over like the next decade, where home prices slowly, in real terms, inflation adjusted terms, slowly come down. It's going to vary by location. Obviously, real estate is always local. I just talked about how the Bay Area is going up extremely quickly in value. So there are going to be some places where home values are going down, some places where they're going up, but the median, I think, is going to go up slower than inflation. So in real terms, going down. So when you ask me like, when is the crash happening? I would say like, well, arguably we're in the middle of it. You just can't tell because it's happening so slowly. MRB 1004 on TikTok says an influencer said a 2-bedroom in the Bay Area is going for $8,000 because of AI. I believe it. It's beginning. It's happening. Like I said, if you have a lease, if you're up for a lease renewal and your landlord does not read the New York Times, get them to lock in, a negligible rent increase for like 2-3 years. Sign a long lease with your naive landlords is my advice. Information is negotiating power, okay? When you're getting this information from me, you know what's about to happen. Maybe your property manager landlord doesn't know yet, and you can, finesse them into renewing your lease for like 2 or 3 years at today's rents instead of next year's rents. That's my advice. All right, I think I promised in my I'm not going to talk about that. I'm just trying to see what other. Oh, I promised I would talk about the Manhattan building in New York City. I think I put this in my live description, so I want to honor that. There's this building in Manhattan that was being redeveloped from a commercial property, an office building, into residential. And these conversions are very tricky because office buildings are not set up like residential buildings. Residential buildings have codes. For one, you need plumbing in every unit for the kitchen and bathroom. Bedrooms need to have windows. They're just regulations. So offices don't need that. For an office, you usually have like one bathroom in the center that's communal, and that's the only place where the plumbing is. But when you do an office to residential conversion, you need to like redo all of the plumbing and maybe some of the windows too. And it seems like with this building, they were going to extend it to make even more units. And that's where things started going wrong and the building started to buckle. You can see here, the beams are buckling. That's fun to say, beams are buckling. Not so fun to actually be there though. But it seems like it's under control now. This is a ongoing story. It'll be really interesting to see like what happens next. Are they able to fix this issue in a manner where they can continue with this office to residential conversion? That New York City needs more housing. They need a lot more housing. So if they can convert these midtown commercial buildings into residential, then that would be great. If it just sits abandoned, which has happened, there's like an abandoned apartment building in Los Angeles because some Chinese investor backed out, then that would be like a blight on this area. It would probably be demotivating to other projects that are trying to do similar things to have like such a failure if it were to be left in limbo. So, I hope that these architects and engineers figure it out and that this is just, a crisis averted, and they do create all these extra housing units and they do more of these office conversions. But I think it just goes to show how tricky they are. They seem simple, but they're really, really not. Okay. We talked about, do I want to talk? I can save this for next time. I talked about that a little bit. All right, I'm getting tired, so I think I'm going to wrap it up. But thank you for coming to my live stream. My name is Daryl Fairweather. I am the chief. I didn't mean to do that. I'm the chief economist at Redfin, and I'm the author of Hate the Game, out now. It's only $2.99 on Kindle, so you can't beat that price. And until next time, I do this every Thursday unless I'm on vacation or sick, so I